I wanted to ask you a question, Stephen, about like what you refer to as like the informal board of advisors that you were referencing. Are those, because I'm kind of fascinated by that idea, are those internal Campus Inc. employees, or are they like people outside of the company?
No. So when we turned into a C corp, we had a stock option pool. And so what I appointed was a few individuals that were if we were to have a board, that were extremely reputable and trustworthy in our industry. Or like one of my professors from college in the MBA program that like been a mentor for me. And so he's on our advisory board, if you will. They get a small amount of stock option. And then there is, expectations. Hey, you're to meet with the founder and their team once a month and meet with the whole team quarterly. And so I believe we've got 3 of them. And it's just kind of this like, we all trust them. If we were to formalize and create a board, they would potentially be board seats. But it's kind of this way of just having like mentors, if you will, or advisors that are sort of tied in a little bit and can help us make hard decisions.
Have you found that to be beneficial so far? Like, have there been situations where you feel like you've needed to call on them, or has it just been kind of a case backup plan for now?
Yeah. I mean, when we're deciding, hey, are we going to go raise another round, right? Like they have vested interest, but they also just have interest in me. And so I could be like, hey, it's also, you can find like really notable people in a specific industry. So one of our advisors was the old executive director of the Pac-12 and is EVP of corporate partnerships for the San Francisco Giants, right? Like he can snap his fingers and get me to different places very quickly. And if we're working on like a big structure of our company, we can whiteboard it with him, right? So, those are the type of people that, you just want in your corner, I guess, when you're going to
sure. Yeah, that's awesome. So, yeah. Thanks for sharing that.
Like they're generally very financially invested. So they, the more seats, the more maybe equity stake or so. I'm curious on the real estate side. So maybe Stephen, you can explain like how you guys set it up with your building. And then I'm curious to go back, James, and best practices for setting this up. So if people are looking, the situation is, all right, I'd like to buy this building I'm in or the next building I'm moving to. What's the best way to set it up? And I'm curious, how did you set it up, Stephen? And you talk about like the LLC owns this one and then there's pay rent and like, what does that look like?
How do we want to go into this? So Campus Inc. moved into a new building in 2018. My business partners sold a piece of property at the time. They wanted to own the building we were in. They wanted me to own a piece of it as well. And so we actually formed 3 LLCs that bought this building together. And so like I have a third undivided interest of this building, and my other 2 business partners each have their own third. There's 3 different mortgages. And then Campus Inc. leases it from those organizations, if you will. And it's like a triple net lease. So Campus Inc. pays for, all of the bills, they pay for all the taxes. And then essentially we just get a check every month to each LLC as rental income. And we did like a 5-year lease. Why that's important is because in that time frame, we actually bought one of those business partners out from Campus Inc., but he still owns the real estate with us. Does that make sense? And so that's essentially an opportunity for me to build equity, make money on the dirt that we're occupying. And then, it's an investment long term that I could do whatever I want with, right? So that's kind of how it was set up and structured. I'm sure that's going to pose some questions. I'll stop there.
So with that said, like, I think there's some tax benefits too, which I know this isn't a tax episode, but I keep going back to it a little bit. But like with depreciation and so on, that you can deduct to over like a 20 or 30-year period or something like that. I don't know. We're not accountants.
I think real estate is 28.5 years or something. It's all different assets have different depreciation schedules, as you're saying. But yes, you're correct. That is correct. There's also some other tax benefits as well. Just the way that the business, we'll call it the business and the holding company. In this example, the holding company is holding the real estate. So just the fact that the business gets to write off the rent that they pay to the holding company. That's an expense to the business because they need to pay rent to continue to survive. And then, so on the holding company side, they're obviously getting income in the form of those rental payments. So they have to report that income. But in the middle there, so like the holding company, for example, may have its own set of expenses, right? So the holding company, for example, is paying potentially mortgage interest. They are paying maybe a property management company. Maybe they're paying an attorney to review and renew that lease or to exercise an option. Maybe they're paying for the facility to be upkept because the holding company owns the facility, so it needs a new roof. That's an expense. And so the taxation is really simple. It really just gives the business an additional expense. It gives the holding company the income to the same amount, but the holding company can then write off expenses associated with the holding company's ownership of that piece of property. So it's better than just it's better than renting, because on the renting side, you just get the credit as an expense to the business and there's no holding company. So in that way, it's pretty beneficial. There's also, we haven't talked about
and you
this
probably write
quite
off
yet,
the
but
interest of the loan, right?
the mortgage interest. Yep.
Yeah, but even if you make money on it, so like, it's another form of income. I am a landlord to Campus Inc. I make money on that every month. So what if I pay taxes on it? I have a 15-year commercial loan on it. In 15 years, that thing's rent free. I'm on year, 6 or 7. I can be a landlord to the next tenant. I can turn around and sell it. And like, I own a 14,000 square foot building. So like, there is just this point of, just owning land and buildings and commercial real estate. That's just nice to have. It's a diversified way to just be a small business owner, whether or not you just pay the full tax on it. Yeah.
That's
so
right.
James,
It's like
did Stephen do it
position.
Right? Did he do it right? Or what's the best practice for setting this type of situation up?
So I've represented a lot of people in this same position, everything from dentists to pediatricians, other physician groups, consulting companies, other law firms. And this is the best way to do it in terms of having the two separate companies. This is
ding.
Yeah, this is right. And you know what? Don't take it from me. I would say, Stephen, you've been in this situation now, you said, for 6 or 7 years. How do you feel? How does it feel in terms of having both things? I think the diversification of income, the additional revenue stream, the extra set of expenses, it makes sense to me, but let's ask Stephen. He's living it. So
yeah. So my business partners are older than me. Jed's 65 and he goes, "You're going to build wealth by owning land." And that was like
the McDonald's model.
He's like, and that's Jed owns farmland. He owns mini warehouses. He's like, this is, I don't care what happens to Campus Inc. You're going to build wealth by owning your dirt. And it was just an old man telling a young person, "Hey, follow me. You're going to do this." And I give my business partner Jed a lot of credit because that's how he's made his money.